Brought to you by the Every Dollar app. Start budgeting for free today.
So I had two questions regarding whole life insurance. I know your general principle, but I've never actually heard you discuss these two characteristics of whole life insurance, or these two scenarios. So I was kind of curious of your opinion regarding this subject, if you don't mind.
Sure. I'm an expert on my opinion.
So the first question is like this. Today in America, if a single person is earning $150,000 a year or less, they can put up to $7,000 into a Roth IRA that grows tax-free. But at $150,000 after taxes, about $130,000, a single person pretty much anywhere in America still has plenty of money. So let's say you're putting money into that investment brokerage account. My question was on whole life insurance. It also grows tax-free. I know it doesn't have the same rate of return, but if a person wanted to increase their long-term tax-free savings, would that be something you would consider as a viable approach, that they've already maxed out their Roth IRA, or if they have a company, a Roth 401k, they still can only max out at $7,000?
Yeah, how long ago did you take your job selling whole life?
I've only sold a couple of policies, but no, I don't. I'm not actually involved in the industry specifically. If you don't.
How did you sell policies if you're not involved in the industry?
Oh, I am a licensed agent, but I haven't done it in a few years.
Because you pretty much spouted their line perfectly. This is the whole life sales line. That's how I knew you were selling it. You nailed it. Like you were just trained like 3 weeks ago. That's what it sounded like. Not picking on you, but you are representative of the industry. Okay, so let me help you with this. Whole life does not grow tax-free. Okay. Unless you lose money. And your basis for tax purposes in a whole life policy is the total of your premiums. So if you pay in $100,000 over a bazillion years into your whole life policy and your cash value is $90,000, you have lost $10,000. And so, of course, there's no taxation. Or you can borrow your own money and pay them an interest rate to borrow your own money. And by the way, 100% of the time, borrowed money is not taxable. So whole life in and of itself does not grow tax-free. That is a falsehood. Mm-hmm. If it actually made money and you took the money out, it would be taxable. But they never do because they suck so bad. The rate of return is horrendous and the fees are so high. And so, no, I would never consider that as an option. Instead, I would, listen, dude, if you put your money in a fruit jar as your side investment after you maxed out a Roth, you're going to end up with more money than you will screwing around with the whole life policy because they lose money.
I'm impressed that you sniffed that out as quickly as you did.
Too much time in 30 years being hated on by whole life people.
That was pretty impressive. I'm not going to lie. I'm impressed.
Yeah, well, I mean, it's a scripted thing that
clearly
it's tax-free growth, which is a complete lie, y'all. It's not tax-free growth. If there is growth and you take it out, it's taxed. Mm-hmm. Mm-hmm. Period. But there never is because the rate of return is so horrible and the fees are so high. So here's the way whole life works for those of you listening. And he's talking about it as an investment only, but let's talk about it as an insurance product, which is what it is purported to be. And you only have to have a life insurance license, not a securities license to sell the crap. So which is easy to pass. If you can roll out of bed, you can probably pass your life insurance exam. It's not that hard. Securities exam, on the other hand, very hard. Now, whole life is 20 times more expensive than the same amount of term on the same person. So a 30-year-old buying a $100,000 policy, if, say, for instance, they did that for $5, whole life would be $100. Okay, so where does the extra $95 go above the cost of insurance? Because term is only insurance.
That's right.
It goes into an investment called cash value, which is what he was bringing up. Okay, the investment called cash value, the first 3 years on a whole life policy, your investment growth is 0. 100% of your $95 a month in our example, the extra 19 times you're paying for this, you get zero in your investment. So you open a bank account and you put in $95 a month for 3 years and the balance is zero.
No one would do that, by the way, if they understood that.
They do it all the time, but no one would do it if they understood that. You're right, which is our goal here, is to make everyone understand it. Then once it does start making money, the average whole life policy in America today averages 1.2% with an inflation rate of 4.7.
Losing money.
And so after you get past those two things, here's the worst part of the whole thing. So this little couple buys a $100,000 whole life insurance policy. They pay into it for 20 years. They have $20,000 in there finally after they got 1.2% and has nothing for the first 3 years. And then he dies. You know what they pay? They pay the life insurance.
Just the premium.
The face amount. What happened to the money I've been paying $95 extra to build up in my savings account? Insurance company keeps it. You do not get the face value plus the cash value.
Well, let me ask this, because
let me finish.
Okay,
right quick.
keep going.
So you have a savings account that the first 3 years you put money in, they keep all of it. After that, you make 1% on it, and when you die, they keep your money. Who would open this savings account? Nobody. But people do every day. It's the biggest, let me tell you, it's the payday lender of the middle class. It's crap. Sorry, Andrew, but you asked.
So when do a guy like Andrew, if somebody said, I'm interested, let's say they had built up a certain amount of cash value, when would a guy like Andrew say, here's the right time to get at that money so it's all a risk game, but so that you can get it before you die?
Well, you can't get it before you die. The only way you could get it is cash the policy in. Because if you borrow the money out
then you're paying
before you die, they repay the debt to yourself to make sure they keep the whole cash value before they pay out the face value. So if you borrowed $20,000 in a $100,000 policy and you died with the loan out, you get 80 instead of 100.
Oh my gosh.
They pay back the loan so they make sure they get to keep it.
Wow. Wow.
So the only way to get to keep the money is to cash out the policy.
And then at that point, why get it to begin
And
with?
you have lost money on it, so it's not taxable.
Terrible.
So no, you're better off putting money in a fruit jar, darling. At least when you die, it's there. Assuming the family knows where the fruit jar is buried. But be careful with that one. That did happen to one of my relatives. we got cousins out there with metal detectors in the backyard trying to figure this one out. But don't do that. Don't do that one either. Create your free every dollar budget today. The simplest way to budget for your life.